My greetings to everyone. I am Professor Namita Rajput, Professor in Department of Commerce, Sri Aurobindo College, University of Delhi. In the ongoing series of corporate governance, we have explored so much about shareholder activism, about the different practices of the different companies, the Indian and the global context we have discussed. But there are still corporate failures, there are still global failures. So let's dive into it in a very interesting session on case studies of the global failures, Enron, WorldCom and Lehman Brothers. So first we are going to discuss about Enron. So Enron Corporation was once a titan of the energy industry, but its spectacular rise was followed by an even more dramatic fall, making it one of the most infamous corporate scandals in the history. So let's talk briefly about this case. The first is the rise of Enron, that is the formation of this company. Enron was founded in 1985 by Kenneth Lay in Houston, Texas, initially as a natural gas pipeline company. Then we'll talk about its diversification. Under the leadership of Lay and Jeffrey Skilling, Enron diversified its operations into the trading electrically broadweight and other commodities. So Skilling innovative ideas was to transform Enron from a simply delivering energy to becoming a marketplace where energy could be traded like stocks and bonds. So Skilling innovative ideas was to transform Enron from simply delivery energy to becoming a marketplace where energy could be traded like stocks and bonds. Then we talk about its financial engineering. Enron became known for its complex financial structure and accounting practices, which allowed it to report very impressive profits and hide its debts. Then started the fall. Like we are talking now about the accounting scandals. Enron downfall began to unfold in 2001 when it was revealed that the company had been hiding significant debts in off-balance sheet entities. The Arthur Andersen Enron accounting firm was complicit in these deceptive practices. Then we'll definitely talk about the bankruptcy of this company. As the extent of Enron financial trouble, it became public investor confidence collapsed, leading to a rapid decline in the stock value, and the Enron filed for bankruptcy in December 2001, making one of the largest bankruptcies in US history at the time. Then is about the legal fallout. There were investigations which revealed a widespread fraud and the corruption within the company, including insider trading and manipulation of the energy markets. And there are several Enron executives, including the Lay and Skilling. They were indicated and convicted of the various charges related to the scandals. So let's do some aftermath of this Enron rise and fall. The first is your regulatory changes. Enron collapse prompted some significant reforms in the corporate governance, accounting practices and the securities regulation, including the passage of the Sarbanes-Oxley Act in 2002. Now let's see the impact it has on the employees and the investors. There are thousands of Enron employees which lost their jobs and their retirement savings as a result of the company's collapse. The investors also suffered some massive financial losses. There was some legacy also. The Enron scandal remains a cautious tale about the corporate deal, ethical lapses, and the dangers of unchecked ambition. It led to some increased scrutiny of the corporate behavior and a greater emphasis on the transparency and accountability in the business practices. The Enron accounting scandals was at the heart of its downfall, revealing a web of deception and the fraudulent practices that had been carefully concealed for the years. So let's see how the scandal unfolded. There was a very important concept of off-balance sheet entities, that is the special purpose entities, SPEs. Enron used a very complex network of off-balance sheet entities known as a special purpose entity to hide the debt and inflate the profits. There was a deceptive accounting in place. Enron transferred its debts and underperforming assets to these SPEs, which were not fully disclosed in the company's financial statements. So, this allowed the Enron to keep its debt off the balance sheet, making the financial position appear more stronger than it actually was. So, let us see what you talk about the mark to market aspects. So, there was a mark to marketing accounting where Enron adopted a mark to market accounting for its energy trading business, allowing it to recognize, anticipate future profits and immediately, even before the transactions were completed. There was a manipulation also. Enron manipulated market to market accounting to inflate its earning by booking the profits on a long term contract at the same time they were signed, rather than over the life of the contract. So, this practice artificially boosted the Enron reported profits. There was an insider deal and the conflicts of interest. The Enron executives, including the CEO Jeffrey Skilling, were involved in numerous conflicts of interest, so profiting personally from deals with Enron. There was a Fastow roles. Enron's CFO Andrew Fastow was the architect behind many of the balance sheet transactions and used them to enrich himself and other Enron executives. There was an unraveling of deception. The whistleblowers. The concerns about the Enron accounting practices were raised by the whistleblowers within the company as well as by the analyst and the journalist. There were investigations. The Securities and Exchange Commission, we call it as SEC, they launched an investigation into the Enron accounting practices, leading to the unraveling of the company's deception. There was a bankruptcy and a fallout. As the extent of Enron financial troubles became public, investor confidence collapsed and the company filed for bankruptcy in December 2001, triggering a wave of lawsuit and the regulatory investigations and the criminal prosecutions. So, let us see what are the important lesson learns for the students and the faculty members as far as the Enron accounting scandal deception unveiled is concerned. Since this is a landmark case as far as the corporate scandal is concerned because of its deceptive accounting practices, let us see what are the lessons learned. The first and the foremost we talk about is the corporate governance. The Enron scandal highlighted the importance of a strong corporate governance, transparency and accountability in preventing the corporate fraud. There are some regulatory reforms also which needs to be talked about as far as the lesson learned are concerned. The scandal led to a significant regulatory reform, including the passage of the Sarbanes-Oxley Act aimed at improving the financial reporting standard and enhancing the oversight of the corporate behavior. Enron accounting scandal serves as a stark reminder of the dangers of unethical behavior and the need for the rigorous oversight in the corporate governance. Next, we talk about a very important case, that is the corporate scandal, global corporate scandal I would say, the WorldCom from telecommunication giant to a bankruptcy. So, let us see this important journey which was on a decline. The WorldCom journey from a telecommunication giant to a bankruptcy is another notable chapter in the corporate history, which is marked by the financial misconduct on a massive scale. So, let us talk about it. The first is your rise of WorldCom. Now, as far as the formation of this company is concerned, WorldCom was formed in 1983 as a long distance discount service, we call it as LDDS, by the Bernard Ebbers, initially focusing on reselling a long-distance telephone services. Next we talk about is the expansion. Through a series of acquisitions, including the MCI Communication in 1998, WorldCom grew into one of the largest telecommunication companies in the world. It provided a range of services, including a long-distance internet and the data transmission. The second we talk about is the stock market success. The WorldCom stock market prices, they soared during the late 1990s. That is the tech boom, fueled by its rapid expansion and ambitious growth plans. Next is your financial irregularities. We talk about the inflated profits. Similar to Enron, the WorldCom engaged in accounting fraud to inflate its profit and hide its financial troubles. Next is your capitalizing expenses. The WorldCom improperly accounted for its operating expenses as a long-term investments, thereby artificially boosting its reported earnings. They also manipulated the financial statement to the substantial extent to show some kind of a consistent growth and also the profitability, deceiving all the investors and the regulators. Now let's see, we talk about now the fraud, that is unveiling of the fraud. The whistleblower, the Cynthia Cooper, the WorldCom internal auditor, discovered the irregularity in the company accounting practices and alerted a senior management. There were restatements also which needs a special mention. In June 2002, the WorldCom disclosed that it had improperly accounted for about $3.8 billion in expenses, leading to the largest corporate restatement of the earning in the history at that time. There are also important aspects of bankruptcy, and let's see aftermath of this bankruptcy filing. Now, facing a massive debt and a loss of investor confidence, the WorldCom filed for Chapter 11 bankruptcy protection in July 2002, one of the largest bankruptcies in the United States history. The executive accountability. The Bernard Ebbers, the WorldCom CEO, was found guilty of the fraud, the conspiracy, and filing the false statements, and he was sentenced to 25 years in prison. Next, we talk about the executive accountability. The Bernard Ebbers, WorldCom CEO, was found guilty of the fraud, the conspiracy, and filing of false documents. He was sentenced to 25 years of imprisonment. Let's talk about the legacy. There was an impact of this WorldCom telecommunication giant to bankruptcy. As far as the legacy is concerned, there was a huge impact on our industry. Let's discuss this. The WorldCom bankruptcy had a significant repercussions for the telecommunication industry, leading to a consolidation and restructuring amongst the competitors. Let's see what are the important lesson learned from this particular scandal. The WorldCom scandal, it reinforces the importance of transparency, accountability, and the ethical leadership in the corporate governance. It also highlighted the need for effective oversight mechanisms to prevent the financial misconduct. The WorldCom downfall serves as a cautionary tale about the dangers of the corporate greed, accounting fraud, and the consequences of the unchecked ambition. The WorldCom accounting fraud, the unrevealing of a corporate empire. The WorldCom accounting fraud was a staggering example of the corporate misconduct that ultimately led to the unraveling of the corporate empire. Let's take a look at a detailed. The telecommunication giant, it was declared and emerged in 1990, and there was a pressure of growth in the hyper-competitive telecommunication market. There was an immense pressure on the WorldCom to demonstrate a continuous growth to satisfy the shareholders and the investors. Then they started doing the accounting fraud, inflated the revenue because in order to meet the growth expectations, the WorldCom, they resorted to a fraudulent accounting practices, inflating its revenue and its earning. There was a capitalization of the expenses also. The operating expenses were illegally capitalized as investments and artificially boosting the profits and masking the company's true financial health. They manipulated also the financial statements. The WorldCom executives, including the CFO, Scott Sullivan, orchestrated the fraudulent manipulation of the financial statement to present a falsely positive image to the investors and the regulators. There was unrevealing of the fraud, that is the whistleblower. Now, we talked about the Cynthia Cooper. She was actually taking care of the accounts and was an auditor. So, in her routine check, she brought them to the attention of the senior manager. Then in 2002, the WorldCom publicly disclosed that it had overstated the earnings by nearly $4 billion, sending the shock waves through the financial markets. There was a huge consequences which were substantially bad, that is, it led to the bankruptcy. Following the revelation of the accounting irregularities, the WorldCom stock plummeted and the company filed for bankruptcy in July 2002, one of the largest such filing in the US industry. The Sullivan and the other executives faced some criminal charges for their role in the fraud, and the Sullivan ultimately pledged the guilty to fraud and received a 5-year imprisonment sentence. Now let's talk about the repercussions. There are thousands of employees who lost their jobs, and the investors, they suffered significantly the financial losses, and the WorldCom collapsed also had a broader implication for the telecommunication industry, promoting a regulatory scrutiny and reforms. Now, there were some regulatory reforms which need a special mention. The WorldCom scandals spurred the reforms aimed at enhancing the corporate governance, transparency and oversight, including the Sarbanes-Oxley Act 2002. So, there was a cautionary tale. Let's discuss that. The WorldCom downfall, it serves as a stark reminder of the consequences of unchecked corporate greed, the unethical behavior and the tax oversight. So, we can say that the unrevealing of the WorldCom accounting fraud stands as a cautionary tale in the corporate history, underscoring the importance of integrity, transparency and the ethical leadership in the business. The collapse of Lehman Brothers in 2008 was a pivotal movement in the global financial crisis. Yes, we are now talking about the third important corporate scandal, that is the Lehman Brothers. So, let's discuss this. The corporate Lehman Brothers in 2008 was a very pivotal, important, key moment in the global financial crisis, signaling the beginning of one of the most severe economic downturn in the modern history. So, let's discuss what were the key events which led to the Lehman's downfall. Let's talk about the background of this company. So, the Lehman Brothers, the collapse of a financial giant, the Lehman Brothers was one of the largest and the oldest investment banks in the United States, with a history dating back to the mid 19th century. There were some diversified operations. The Lehman engaged in a range of financial services, including the investment banking, the trading asset management, and the investment management. So, what are the factors which led to the collapse? It's a very, very important part to discuss as far as the collapse of the Lehman Brothers are concerned. So, there was a subprime mortgage exposure. The Lehman Brothers had heavily invested in the mortgaged backed securities, including the subprime mortgages, during the housing market boom of the early 2000s. There was a leverage and a risk. The firm had taken on significant leverage to finance its investments, making it highly vulnerable to the fluctuations in the asset value and also the market conditions. So, we are discussing the important factors which led to the collapse of the financial giant Lehman Brothers, which was an important bank in United States. So, first we discussed about that what was it and what were they into. So, we discussed that they are the largest, oldest investment banks in US, which started its journey late in mid 19th century, and they dealt with the diversified operations, like they were into many activities like investment management, asset management, banking, trading, etc. So, owing to which it attracted all the importance. So, there were few important factors, few important causes which needs to be discussed at length, that which led to the collapse of the financial giant. So, there was a subprime mortgage exposure, as we have discussed in the in the early 2000s. There was a huge boom of the housing market. So, the Lehman Brothers, they had heavily invested in the mortgage based securities, including the subprime mortgages. So, they also had the firm had taken on a significant leverage to finance its investments, making it highly vulnerable to the fluctuations in the asset values and also the market conditions. So, definitely there was a liquidity crunch, and as the subprime mortgage market collapsed and the housing prices plummeted, the Lehman mortgage related assets, they declined, and hugely declined as far as their value is concerned, which led to a liquidity crisis. And there was an attempt to survive also relating to this, which needs a special mention. So, as far as this is concerned, at the end I would like to say that there were important causes, there were important factors which the students must know. And as a matter of fact, this global knowledge will open their seed for discussions with their class teachers, with their classmates. That is what led to what, and also some thought provoking aspects in their mind, that what was a subprime mortgage exposure, what was a leverage, what was the risk, as we have discussed, and what led to the liquidity crunch of these Lehman Brothers, owing to which this scandal took place. Because as the subprime mortgage market collapsed, the housing prices, they were declined, and the mortgage rates assets also declined sharply, leading to a strong, very heavy liquidity crisis. So, this is all about this lecture. Thank you so much.